Okay, good afternoon everybody. Please come in and go and take a seat and fasten your seatbelts because this is going to be an exciting session. In this session we're going to talk about all the things that are keeping monetary policymakers awake at night, including geopolitical turbulence, the more gradual, slow-moving forces of structural change, and the implications for real activity, inflation, and monetary policy. And we have an absolutely fabulous panel to shed their insights on these topics. First of all, we have Isabel Schnabel, Executive Board Member of the European Central Bank. Then we have Vítor Gaspar, who moved from the European Central Bank to the IMF and focus on fiscal policy. And then we have Clemens Fuest, head of the IFO Institute. So without further ado, I suggest we simply get started because we have so much interesting ground to cover. So Isabel, the floor is yours.
So thank you very much to the organizers and to Volker in particular for having me this conference. It's always a highlight of the year and I really enormously enjoyed the first part of the program. So when you ask a central banker to talk about structural change and implications for monetary policy, most will probably talk about the concept of R star, and this is actually what I'm going to do over the next couple of minutes. So over the past 2 years, we have seen a measurable and persistent rise in real interest rates across many advanced economies, partly reversing the secular decline that started in the early 1980s. And this increase in real rates has reignited the debate among academics and policymakers about the level of the natural rate of interest, or R star, that is the real short-term interest rate that would prevail if the economy was operating at its potential and inflation was at target. And the question is whether the recent reversal is a sign that real interest rates will remain higher once the impact of recent shocks has faded, or whether they will return to the lows seen in the pre-pandemic era. In my remarks today, I will discuss two hypotheses that can help explain the fall and rise in real interest rates. The savings investment hypothesis argues that structural determinants of global saving and investment are the ultimate drivers of the natural rate of interest and hence real long-term rates which are anchored around R star. And according to this hypothesis, the persistent decline in real long-term rates in the pre-pandemic era was a result of a combination of low investment at times of globally declining productivity growth, high savings due to an aging population, and a high demand for safe assets in response to global currency and financial crises. The monetary policy hypothesis argues that monetary policy may have played a role in the persistent downward trend and subsequent rise in real interest rates. Since R star is a theoretical construct that is unobservable and the economy's long-run evolution is surrounded by considerable uncertainty, financial markets often look to the central bank for informing and coordinating their views about real long-term interest rates. And by providing long-run guidance, the central bank may influence long-term interest rates. And to the extent that the signal inferred from central banks has an impact on private consumption and investment decisions, it may even result in informational feedback loops inducing shifts in R star. The implications of these two hypotheses for the role of monetary policy are quite different. While in the first case, monetary policy merely responds to global structural changes, in the second case, it may have long-lasting effects on economic activity. Oops, sorry for that. So as you can see on my first slide, in the decades following the inflation spikes of the 1970s and early 1980s, we have observed a gradual and persistent decline in real short and long-term risk-free interest rates globally. And model estimates show that R star too has followed a persistent downward trend over the past decades leading up to the pandemic, even if there's some disagreement about its precise level, given high model and estimation uncertainty. This co-movement is not surprising. If real long-term rates are driven by fundamental forces, then they should align closely with R star over the long run, once the impact of temporary demand or supply shocks has faded and the economy has moved back into equilibrium. In other words, R star serves as an anchor for real long-term rates. Over the past 2 years, however, this downward trend seems to have reversed. Real long-term yields have increased considerably across advanced economies. And this rise has not just been driven by an increase in spot short-term rates due to the highly synchronized global monetary policy response to the inflation surge. It also reflects a reassessment by market participants of the expected level of real short-term interest rates prevailing in the future. For example, as shown on the slide, respondents to the survey of monetary analysts expect the ECB's deposit facility rate to level off in a range between 2% and 2.5% over the long run. Given an expected inflation rate of 2% over the same horizon, this would correspond to an R star of 0 to 0.5%. The ECB's model-based estimates have shown a similar upward trend. These estimates are around 1 percentage point higher than before the start of the monetary policy tightening cycle in December 2021, when median survey expectations and model estimates of real short-term rates were in negative territory. Market-based proxies of R star in the euro area have also increased measurably since late 2021, as you can see on the left-hand side. The shift is even more pronounced in the United States, where market participants price an expected average real short-term rate of above 1% over the long run, substantially higher than in 2021. So, what factors can help explain these developments in real long-term rates and R star? One explanation is offered by the savings investment hypothesis. Within a standard macro framework, and as shown on the left-hand side of this slide, changes in equilibrium real interest rates are determined by structural shifts in savings and investments. An increase in desired investments for a given level of desired savings puts upward pressure on real interest rates. In a world with free capital flows, real interest rates are determined globally, in line with the remarkable co-movement across major advanced economies. Over the long run, and without any frictions in financial markets that prevent capital from moving freely across borders, there exists a single equilibrium interest rate that clears the global capital market. Global R star thus acts as an anchor for domestic R star. Proponents of the savings investment hypothesis have put forward two main factors by way of explaining the fall in R star, and hence real long-term rates in the pre-pandemic era. The first is the trend decline in productivity growth, which lowered the marginal return on capital and thus the demand for investment. A second key driver was a persistent rise in savings, what Ben Bernanke called the global saving glut. Large current account surpluses in emerging market economies with shallow financial markets and the series of currency and financial crises led to a rise in savings, exerting downward pressure on R star. Higher risk aversion after the global financial crisis, together with demographic forces such as higher life expectancy and lower retirement, further contributed to an increase in desired savings. Recent research indeed suggests that the bulk of the decline in global R star since the 1970s can be attributed to slowing productivity growth and rising longevity, as shown on the right-hand side. The savings investment hypothesis can reconcile the marked divergence in views about the likely persistence of the recent rise in real rates. To see this, it is useful to think about the natural rate as having two components: a very slow-moving, long-run component and a more cyclical component that can drive the natural rate away from its long-run trend over a protracted period. And this is consistent with recent evidence suggesting that real interest rates have oscillated around a persistent downward trend since the start of the Renaissance in the 14th century. And if there's one chart that you should take away from this presentation, it's this one, which is really very interesting. Temporary but protracted reversals in the interest rate regime happened at times of major and persistent structural shocks, such as the Black Death in the 1350s or extended periods of war. After the Second World War, for example, major investment was needed to reconstruct the European and parts of the global economy, which put upward pressure on our star over several decades until it started to decline in the 1980s. Today, the situation may be similar. It is possible that the fundamental forces driving our economies in the long run have not changed, despite the series of shocks we have witnessed in recent years. As such, an aging global population and continued subdued productivity growth may remain a drag on real interest rates. At the same time, overcoming the challenges we are currently facing may ultimately require changes to our economy that are large enough to offset these fundamental forces over the coming years and possibly beyond. Specifically, climate change and the green transition, geopolitical shifts due to the Russian invasion of Ukraine and tensions between the United States and China, as well as rapid advances in artificial intelligence and digitalization, will require exceptionally high investment. The transformation towards a climate and nature-preserving economy may in itself necessitate investments comparable to what was required to rebuild the European economy after the Second World War. According to estimates by the European Commission, annual investment in the energy system in the 2020s needs to be twice as high as in the preceding decade if we want to meet the objectives of the Fit for 55 package. In addition, the higher frequency of extreme weather events is likely to necessitate extensive public and private investment for both rebuilding and adaptation. In the United States, the number of billion-dollar disasters has risen exponentially, from just 3 on average in the 1980s to 28 in 2023. Moreover, benefiting from the rapid advances in artificial intelligence and exploiting the full potential of digitalization will require large public and private sector investments in physical and human capital for acquiring and implementing new technologies and reshaping business processes. Such investments will be particularly large in the EU, which has been lagging the United States and China markedly over the past years, as you can see on the right-hand side. Finally, companies that seek to make their supply chains more resilient by diversifying their sourcing strategies will generate another major push towards higher investment. According to an ECB survey, leading firms operating in the euro area expect to become much more active in nearshoring or friendshoring operations over the next 5 years to make their businesses more resilient. Geopolitical risks and climate change are seen as the two most important factors for relocating production and business operations to the EU. Such relocation could unleash a new wave of capital investment in physical infrastructure. Considering that part of these massive overall investment needs will be government financed and that in the new geopolitical situation, defense spending may have to be significantly stepped up, public debt burdens are likely to rise. Furthermore, aging societies may put an additional burden on public budgets. Higher net issuance, in turn, may face a shrinking supply of global savings, as a gradual retreat in globalization may reduce current account surpluses. Overall, therefore, investors' anticipation of higher private and public investment needs may have put upward pressure on real long-term rates, potentially marking the beginning of yet another protracted period of R* deviating from its long-run trend. The second key explanation of the trends of real interest rates suggests that monetary policy itself may play an important role for real long-term interest rates. This hypothesis starts from the observation that, despite its theoretical appeal, there has been little evidence of a stable relationship between real interest rates and standard proxies of the key determinants of savings and investment across subsamples over the past 150 years. Some key factors, such as demographics or productivity, have the expected relationship with real interest rates in some subsamples, but not in others. Taking an even longer perspective over several centuries casts more fundamental doubt on the conventional wisdom that the decline in global real rates can primarily be explained by productivity trends. The persistent increase in total factor productivity growth after the Industrial Revolution in the 18th century coincided with the downward trend in real rates. The view that monetary policy may help explain these deviations, at least temporarily, is not new. Over the past 2 decades, the literature has studied extensively whether and how monetary policy can have long-lasting effects on real interest rates, going in different directions. On the one hand, overly tight monetary policy may lower investment and technological growth. On the other hand, persistently expansionary monetary policy may lead to the buildup of financial imbalances and contribute to zombification, reducing potential growth. However, the most recent literature has added an interesting twist to the debate, arguing that the most important channel of monetary policy relates to central bank communication. Recent research documents that the descent in US real long-term yields over the past decades can be explained by very narrow time windows around the Federal Reserve's monetary policy meetings. Outside these windows, changes to real long-term interest rates have been short-lived. According to this study, long-run forward guidance, as expressed by the dot plots, appears to have lowered real bond yields by around 130 basis points over the last decade. New research by ECB staff corroborates these findings. It shows that a 100 basis point US monetary policy shock has historically been associated with a 30 basis points increase in R* over the long run. As monetary policy is thought to be neutral over the long run, these findings are puzzling. At a deeper level, however, they may not necessarily be at odds with the savings investment hypothesis. Even if financial markets may ultimately look to the central bank for information about the long-run evolution of the economy, the thinking behind central bank communication may still be guided by models built on the interactions between savings and investment. In any case, these studies suggest that the recent rise in real long-term rates may be partly due to financial market participants interpreting the policy tightening, as well as recent central bank communication, as a shift in policymakers' beliefs about the level of R*. In other words, the impact of monetary policy actions and communication may be stronger than conventionally assumed. This would also imply that central banks have little to learn about the natural rate of interest from looking at market prices, as we may just be looking in the mirror. Taking this argument further, central banks shaping investors' beliefs about R* may even result in informational feedback loops. For example, easing monetary policy could be seen as signaling a lower R*, inducing firms and households to become less optimistic about the economy. This could negatively affect output and inflation insofar as it influences spending decisions. The central bank may then cut rates even further, validating private sector beliefs and weakening the expansionary effects of the policy rate easing. In this interpretation, the inability of central banks in the pre-pandemic period to bring inflation back to target may partly have been due to self-reinforcing dynamics. If monetary policy easing during that period was interpreted as containing adverse information about the long-run state of the economy, the contractionary effects of the resulting feedback loops may have contributed to persistent declines in R*. To conclude, protracted reversals in real interest rates have occurred repeatedly in history in the aftermath of large economic, political, or social shocks. We may now be facing such a turning point. The exceptional investment needs arising from structural challenges related to the climate transition, the digital transformation, and geopolitical shifts may have a persistent positive impact on the natural rate of interest. Whether the anticipation of these investment needs has directly been driving real rates in recent years, or whether monetary policy has been a catalyst for the repricing, remains subject to discussion. It is possible, however, that the determined monetary policy response to the inflation burst may have shifted market participants' beliefs about R*, thereby making a return of secular stagnation less likely. That said, the uncertainty about how central bank actions and communication affect real long-term rates suggests that policymakers need to tread carefully. Rather than looking to financial markets, which could just be a mirror of ourselves, we need to thoroughly examine whether the fundamental sources driving the economy over the long run have changed and communicate these views prudently. Thank you very much.
Okay, thanks very much. That was a fantastic start of the panel. So we now move on to Vítor's presentation. So you'll be focusing more on geopolitical side and the fiscal policy aspects of it. Vítor, the floor is yours.
Thanks, Petra. Such a pleasure to be here with so many old and new friends around. It is truly a privilege. I'm going to use this opportunity to give you a view from outside, a view from afar. You can think about the view as coming from Washington, or if you prefer, Beijing. So from outside the Union. And I will not be focusing on monetary policy at all. I will be focusing more on politics, economic policies, and fiscal policy, which happens to be my job. So I want to speak a little bit about geopolitics and growing fault lines. Then I want to look at a smaller Europe in a growing world, and finally look at some fiscal policies in the EU, but taking the European-wide viewpoint. My messages are amazingly simple, and in case Petra gets the temptation of telling me to shut up, the message is first, geopolitics and the way geopolitics interact with economic and financial dynamics is complex, and it's impossible to tell a simple story. Secondly, the point that if Europe is becoming smaller economically and financially in a growing world, the case for European joint action is stronger. And third and last, the response in Europe to the pandemic with the Recovery and Resilience Fund is an inspiring example. Can I continue, Petra, or should I stop now? Okay. So, long and variable legs, apparently. So if you look at the media, you see lots of talk about geopolitical risks, conflicts, fragmentation, deglobalization, what have you. So the headlines look alarming. what about the trends that we see in the data? This comes from a presentation that my boss delivered in December, and it gives you the trend of the share of global trade on global GDP in a very long run time series. My boss is Gita Gopinath, no longer Ottmar Issing. But what you see here, which I actually find amazing, is that we did have a period of very strong globalization in the world, and the recent period has one of stability in the share of trade on global GDP, something that one could call slowbalization rather than deglobalization. What we do see, and it's interesting, is that the trade share has stayed more or less constant, but when you look at patterns in terms of geopolitical distance across countries, you see that trade between more geopolitically close countries has increased and across blocks has declined. So a change in composition, not a change in the level of global trade. And here I added some lines to this slide, and basically the additional lines are the frequency of the use of some words in Google, in the search, in printed publications. And what you see is that globalization is actually quite a recent word that basically starts and takes off during the 1980s, while integration has a much smoother path, which is growing for most of the more than 100 years covered in the chart. Now, geopolitical uncertainty or geopolitical risks is a much more volatile type of series, and actually, although quite significant in the recent past, the current peak in geopolitical risk is not particularly elevated by historical standards. The two spectacular peaks in the chart have to do with the two world wars. And so you can see from this that clearly political factors and economic trends and financial trends are co-determined and co-evolutionary, but the relationship is complex and different stories may play out in quite substantially different ways. So here, what you can see, I do know my stuff, but delivering a presentation without seeing the slides is quite challenging, and so if you don't mind, I will slightly turn around. So what you see on the right-hand side is that growth is actually, it's not moving. It's in the ECB watcher, ECB and its watcher is quite nice, and vintage 24. So you see on the right-hand side that the world economy is growing. You have the various colors giving you different blocks. But if you want to look at shares, you actually see that at this point in time, Europe is substantially below the United States. Europe is the dark blue. The US is the light blue. In the 2000s, the US has decoupled in size of Europe, and at this point in time, China is also bigger than Europe, and of course, China is growing at a different trend. Here, what you see is that this type of smaller Europe type of line also applies on the financial side. On the left-hand side, you have the share of the euro in the issuance of bonds in international markets. And on the right-hand side, you have the size of the European banking system compared with other banking systems. And of course, the European banking system is bigger than the US. The European banking system, the European financial system is bank-based, the US is not. But what you see there is that the Chinese banking system has overtaken Europe in terms of size of assets. Now, here, I like to quote Jean Monnet. Jean Monnet said in 1954 that our countries are too small for the world of today. They're too small for the US and Russia of today. They're too small for China and India of tomorrow. That is something that he said 70 years ago. He was making a passionate plea for European integration. At that time, in 1954, Europe was substantially bigger in the world economy than what it is today. I would submit to this group that the case for unified European collective action is stronger today than it was 70 years ago. Now, Europe is also relatively open. Germany is an outlier. Germany, among countries of some size, is super open. And what you see on the right-hand side is that geopolitical patterns and geopolitical distance actually does shape the way trade is playing out in the world today. Fiscal policies in Europe. What is it that I want to emphasize? Now, one aspect that comes from geopolitics is that economic measures that restrict trade are on the rise. In that group, industrial policies play an important role. And if we look at Europe in the world, Europe actually implements quite a number of industrial policies. In some cases, or in most cases, those measures are taken at the national level. Those measures are subject to European rules having to do with competition and state aids, but the enforcement of state aid rules has been weakened, and I would claim that the case for European strong coordination applies here as well, because by acting in a concerted European way, it's possible to reconcile the political desire for a more active industrial policy with the preservation of the single market, which is probably the most important competitive asset of Europe right now. Now, it does seem to me that the Resilience and Recovery Fund that was agreed in the context of the response of Europe to the pandemic has worked reasonably well, and it has led to a benign adjustment of the European economy to the pandemic shock, and one can interpret the presentations this morning about the adjustment path in the European economy in that context. Now, the situation in terms of fiscal policy is complicated because, as I was arguing, using the example of industrial policy, there are spending pressures. Other spending pressures are in the pipeline. Just now, Isabel referred to pressures having to do with population aging, defense spending, and much else. And so we have spending pressures. On the other hand, taxation, which has never been very popular, is probably more salient politically than normal, and so there is tremendous resistance to increases in taxation. But of course, if one starts from a deficit position, spending increases and taxation does not, then what happens is that public debt will increase, likely public debt to GDP increase, and if that process continues for long enough, there are threats to public debt sustainability and financial stability. So that's a big thing. That is something that we call the fiscal policy trilemma. And you see some estimates, which are rough, that show the pressures on spending that one can conjecture play out in the context of the European Union. And you can see that climate, as Isabel was referring to, but also pensions, healthcare, defense, and industrial policy play a role in the European Union. What do I take from all of this? Well, geopolitics follow a political logic which is fundamentally different from the logic of economic and financial globalization, although the two are co-determined and co-evolutionary. The single market is something that the European Union should definitely bet on as a very important asset that applies to goods and services, but also on the financial side, where financial union is a very important priority. The increased salience of geopolitics and the importance of geopolitical proximity in shaping trends in trade and finance strengthens the case for collective action at the European level, and the response of Europe to the pandemic is an example that offers hope. And that's it. Thank you.
Thanks very much, Vítor, for this really enlightening overview of geopolitics and fiscal policy trilemma that it creates. We now move on with Clemens. He's going to talk about both the geopolitical and structural change aspects, focusing on trade.
Thank you, Petra, and thanks also to the organizers, to Volker in particular, for the invitation. It's a very interesting event. We haven't, I have to admit, put much work into coordinating these contributions, but somehow I think this fits nicely and complements some of what has been said. So as Petra just said, I will focus on trade and trade frictions and the cost of fragmentation in the global economy. But I'd like to start out from mentioning something Isabel highlighted in the context of our star, which is that if we look ahead, we do face a number of, you could call them structural shocks or negative supply shocks, partly maybe also demand shocks, but these are all shocks either requiring structural change towards more investment, and I suppose in a fully employed economy that could mean less consumption, which is challenging in many ways, and shocks reducing productivity and economic growth. And I guess the task for monetary policy and fiscal policy really is to look at these factors in combination, as Isabel just did indeed, and ask, what does it all mean? I guess one of the implications probably is that we discuss these things very much in the area of fiscal policy. We discuss these things very much in a financial context. Should we not allow for more debt? but there is the real side to the issue, meaning if we could solve these problems by printing colors on paper, producing government bonds, that would be great. But there are serious restrictions on the ability of the economy to produce all these things or to realize all these ambitious plans that won't go away. So we need to, we need an answer to that. So this is about, I will focus on the first point here on trade frictions, and Vítor has already shown a variant of this graph. So we do have experience with slowing trade. So since the financial crisis, you all know these numbers or have seen them somewhere, we have experienced a slowdown of international trade, and indeed that slowdown was at least partly due to trade frictions and increasing protectionism, non-tariff barriers, and so on. So it's not something that's totally new, but of course the fear is now, or the concern is now, this will maybe become worse, or maybe it has already become worse as the governments increasingly engage in subsidizing domestic production, reshoring production partly at very high cost. So, if we are facing a phase of declining globalization, how costly is it? And I would like to present some evidence on that from a recent IFO study we did. So at IFO, we run a world trade model that allows to analyze frictions, the impact of frictions in trade on global welfare. It's a relatively simple model. It's a static model, but it is rich in terms of coverage of countries, and it is relatively rich in terms of sectoral coverage. But it's a static model, so the interpretation is this model doesn't focus on the transition, which maybe is the most difficult part, but what this model tells you is, okay, if you have an increase in trade frictions after having adjusted to it, what is the loss? What is the economic loss? So I guess you have to interpret these numbers you will see as something like a lower bound of the cost of geopolitical frictions. Here are some numbers. We've also seen some of that before, so we know that the EU's overall role in world trade has declined, its share in world trade has declined, but you see this on the right hand, no, you see this on the next slide. So if you ask, how much does the EU depend on international trade, then you see dependence on the import side and on the export side has increased. So the EU has become smaller in the world, but it has become more dependent on the rest of the world, whereas the United States has become less dependent, a little less on the rest of the world, and even China in recent years has become less dependent on the rest of the world. Here you see a variant of these numbers, so there are some serious asymmetries here in mutual dependencies. In the upper panel you see value added in export as a percentage of total value added. So how much do the EU, China and the US depend on foreign demand? And there you see, yes, the EU depends quite strongly on foreign demand. China does as well on demand from EU and the US, and as you're probably aware, the US depends significantly less on foreign demand. What's important for the EU in terms of geo-economic dependencies is that we depend a lot on foreign demand in our most productive sectors, in the high-tech manufacturing. So our high-tech manufacturing sectors depend a lot more, perhaps also unsurprisingly, on foreign demand and foreign inputs, so imports. I guess that suggests that, yes, the EU depends a lot more on open international markets than other regions of the world. Okay, and what we've done now is use this trade model to run some scenarios and think about the cost of geo-economic fragmentation. How high is it? And of course, what you find here very much depends on the scenarios you put into the model. We've put in 5 scenarios here. The first is one where the EU basically engages in reshoring policies and imposes barriers on imports. Of course, the question is how high are these barriers? So as a result of the policy measures we consider here, EU external trade declines by 30%. And the idea is, yes, these can be tariffs, but they can also be reshoring policies, subsidizing semiconductor factories at home and so on, things we are doing at the moment. And yes, we are spending a lot of money on that. So that's scenario one. Then scenario two, the US and China follow similar policies. And then we have three scenarios about global trade blocs. And we look at the world here thinking about it as consisting of three blocs. There's the West, so the EU and the US. There is the East, Russia, China, and so on. And then there are the non-aligned countries. And the basis here is voting behavior on the UN vote on suspending Russia from the Human Rights Council in April 2022. So the non-aligned countries are countries, you see this here, like Mexico, Brazil, India. So they are important in the world economy, South Africa, Saudi Arabia, and so on. And then you have the East and the West. And so scenario three is one where these two blocs stop trading or reduce trade with one another, but they continue to trade with these non-aligned countries. And then you could have a scenario where the West kind of succeeds in convincing the non-aligned countries to join it and to come up with trade barriers or reduce their trade or their economic cooperation with the East, so with China and Russia. Or you could have the other scenario where the non-aligned countries side with China and Russia. Okay, so we now look at what these scenarios mean. And so I won't go through all of these scenarios, but the first scenario, EU reshoring, is very costly. So here in this model, we find that this EU reshoring scenario, where nobody else does anything, but the EU just engages in more reshoring, reduces GDP or reduces real incomes, and in that case by 5%. And in this kind of model, that's a very, very large number. Normally you find smaller numbers in these models. Because, as I said, this is not about the cost of transition, this is just about the new equilibrium and the welfare losses. So if the EU and the US then do the same, that doesn't change much for the EU, it does make things a little worse. What would be a lot better would be a scenario where the EU doesn't engage in reshoring, but we have conflicts between the East and the West, but trade continues in particular with the non-aligned countries. That's scenario three, and you see that's what's called incomplete fragmentation, and the losses for the EU, also for the US, are a lot smaller. So this is about 1 to 1.5%. And then another interesting scenario is where the non-aligned countries side with the West, so they continue trading with the West but not with the East. And in that case, you see that China is extremely vulnerable to fragmentation, so the losses are clearly highest for China. Okay. What you also see in this trade model is that the non-aligned countries have a clear interest in, if they have to choose a side, in choosing the side of the West. Unsurprisingly, because economically the West is still larger, the losses for them are, or the gains for them, in fact, they win due to trade diversion. They are larger. For them, it's more attractive than siding with the East. Okay, now we look at some other issues. Maybe we don't have to get into this, of course. What this causes is significant structural change. More fragmentation means manufacturing sectors and most service sectors lose and some sectors win, but these are just sectors like agriculture and mining. So we have few winners in Europe. But I guess what follows from that is pretty clear. Now, first of all, geo-economic fragmentation is very costly, and what's particularly costly is a policy of EU reshoring. So there are people who are enthusiastic about subsidizing domestic production, but it's a very costly policy. So you have to have very good reasons to engage in this kind of policy. if the West manages to maintain integration with non-aligned countries, the cost of trade frictions will remain limited. So what this model tells you is, yes, there is a loss if there are more trade frictions with China, but the West can live with it as long as integration with other parts of the world is maintained. And of course, you know, we have had this debate about Mercosur. This just underlines the importance of diversifying trade and getting to new trade agreements. Yes, final point, reshoring is very costly. And there's currently a risk, and that's related to the subsidies question. There is a risk that an increasing number of sectors in Europe lobby successfully for reshoring subsidies and or protection from foreign competition. Everybody claims to be strategic. And I think we need a very thorough debate if we want to avoid, you know, or minimize the cost of these geopolitical tensions. We really need, in a way, I mean, it's good that there's not much money around, because that's fortunate, because otherwise we would have few breaks, I'm afraid, on all these protectionist subsidies. I think we need a critical debate about what really is critical and where we cannot depend on others. You know, antibiotics maybe, okay, you know, that's a critical good. If there is a conflict and we don't have that, we have problems within 4 weeks. But solar panels and wind turbines are definitely not critical. We can live for a long time if we are cut off from solar panel imports because we have an installed capacity. So it would be a huge error if we started, that's my view, but something we can certainly discuss, if we started, you know, subsidizing these things as well, because then we're approaching this very negative, broader reshoring scenario, something we need to avoid. Thank you.
Yeah, thanks very much, Clemens. So that's very nicely fitted with the theme. We're going to continue our debate with lead questions. Unfortunately, Sylvain Brailler had to leave early. So the first question will be asked by Fritzi Köhler-Geib, KfW. The floor is yours.
Yeah, thank you very much for the enlightening presentations. I think throughout the day, it has become clear that the probability of monetary easing starting this year has increased. And therefore, as has also come up in Isabel Schnabel's presentation, the question arises, where will interest rates lie in the medium term in Europe? And I think this is particularly also relevant in this environment where we're talking about a transformation that needs to be financed, where the private sector has to play an important role. And I'd be very interested in your expectations, of the panelists' expectations on where medium-term interest rates could lie. So, with regards to decarbonization, deglobalization, and demography, they tend to drive up the medium-term equilibrium interest rate. So will we be in an environment where the private sector has the incentive to invest in the transformation, and or will monetary policy have to be accompanied by a restrained public fiscal policy for the private sector to do its part? So I'd be really interested in this interplay of monetary and fiscal policy that you envisage in that equilibrium and where interest rates could lie. Many thanks.
Okay, thanks. The next question is by Jörg Krämer, Commerzbank.
Yeah, thank you very much. As a banking economist, I also have a question for Isabel Schnabel about R**. You talked about the decline and the rise in R**, the equilibrium real interest rates. But couldn't this decline and rise in R** be caused by inflation itself, or to be more concrete, by the role of inflation in estimating R**? If the inflation rate is low, then according to most of the models, this is due to a weak economy, which can be caused by restrictive monetary policy. And restrictive monetary policy means you have a low R**, which is exceeded by the policy rate, or the other way around. Now you have a high inflation, and the models tend to blame a loose monetary policy. That means at a given policy rate, that means R star to be high. What's your view on the role of actual inflation when it comes to estimating R star?
Okay, thanks. The third lead question is by Carola Schroeder, Union Investment.
Vielen herzlichen Dank für die fantastischen Vorträge. Ich würde gerne auf das Thema Globalisierung. I would love, sorry for me talking in German. I just want to point to the globalization thing. Believe a greater integration of economies around the world during the era of globalization has increased the impact global forces have on national and regional variables such as economic activity, interest rates, and inflation. In other words, the impact of inflation in the US and China on Eurozone inflation is stronger now than in the past, while the impact of price pressures generated in the Eurozone itself is weaker. This trend has it made more difficult for central banks to meet their inflation targets, especially in open economies as the Eurozone, because more of what is driving the inflation is beyond their power. The dynamic restructuring of supply chains with more decoupling and reshoring, as mentioned by Vítor and Clemens, the globalization leads to more regionalization. Some sectors of the economy will become less integrated with other parts of the world again. I've got two questions on that. First, in your opinion, will the restructuring of supply chain increase the power of domestic forces, playing a bigger part again for national and regional inflation? And second, for the sake of the argument, say domestic forces will in fact matter more again, is inflation targeting becoming less difficult or even easier again?
Okay, thanks very much. Very stimulating questions. So before we open up to the floor, I already see a lot of hands. I'll suggest we first go down the panel and answer this first round of questions, please. So we'll go in the order of the presentation. So Isabel first.
So thank you very much for the excellent question. So I think I probably gave already a bit of an answer to Fritzi's question in the sense that I do see certain reasons to believe that there is upward pressure on our star. But just to be very clear, there is huge uncertainty. And we really don't know. If you look at all the models that are estimated, the confidence bands are huge. And I mean, that is one of the challenges, of course, that also monetary policy is going to face, how to deal with this uncertainty. I mean, maybe on your other point, I mean, my personal view is that the financing costs are not the major impediment to investment. And this is actually, this comes out very frequently out of surveys, and also when I talk to people, that it's not the main thing. And I would actually like to hear your views about that. So if we have, I mean, we also saw that, you know, when interest rates were extremely low. I mean, you could have expected, you know, a real investment boom given all the challenges that we were facing, but it hasn't really happened. So that's one of the things to maybe discuss. So on Jörg's question, interesting point. I mean, of course, you were mainly, if I understood you correctly, I mean, you were basically mainly referring to the Holsten-Laubach-Williams estimation of R star, but of course we have many different models which more or less come to similar conclusions, not as regards the level, but the precise level, but directionally. So that would be my answer to that. And then on, I mean, on Carola's question, I mean, there is indeed, I mean, there was this discussion about the globalization of inflation, and that was quite an active debate also during the pandemic, where we saw that, for example, this this shift in the US of consumption towards durable goods, that basically, I mean, that had repercussions everywhere, even in regions where this did not happen. And so, and because it created shortages here and there and so on. And so this certainly is an important issue. Of course, we also have very strong spillovers through financial markets. I also mentioned in my presentation that our star in the end is a global concept, and that it's very hard to move away from that in a certain region, at least systematically. And so, I mean, I still think we do see there is a certain role, of course, for monetary policy to steer inflation, and I think we've seen that our monetary policy has been quite effective in dealing, of course, with the domestically driven parts of inflation, and these are, of course, still there, and actually they are the ones that currently are most on our minds. Vítor?
Thank you so much for excellent questions. I will try to be telegraphic because I could speak for a very, very long time. On the issue of finance, Fritzi, which I think is a very good question, when I think about what is it that public finances can contribute to make the financing of the economy easier and the role of the private sector more important, I would say make sure that the liabilities that are issued by the Treasury are regarded as safe assets. But when you think about it in this way, you actually think that generating a safe asset itself requires a comprehensive strategy. And the most famous cases of countries that have introduced historically safe assets, the three cases that I know best are the Dutch in the early 17th century, the English in the end of the same century, and the US since the foundation of the Republic. And one of the things that is important to understand is that in all these cases, economic growth was strong as well. The process was comprehensive. The strategy was holistic. And I believe that by and large applies today as well. You cannot do it by bits and pieces. You have to know where you want to go and what pieces of the puzzle you have to put in place. The second point, if you allow me, Jörg, the link that I would make between inflation and real interest rates would be I would say, quote from my very good friend and countryman Ricardo Reis from the London School of Economics. He basically says that price stability is the treasurer's best friend. The treasuries, by and large, issue promises to pay a nominal cash flow. And in order for people to value that nominal cash flow, price stability is absolutely key. So monetary policy does have a bearing on real interest rates by underpinning the value of a cash flow of nominal liabilities. And in that case, the central bank, by delivering on its mandate, is actually being the treasurer's best friend. And I think that that's actually good. It's something that I like. When I think about geopolitics and global patterns, I'm led to an example that was used by my boss again, Gita, when she was looking for an example of geopolitics and how it affects places. She used the example of Europe and the energy crisis associated with Russia's invasion of Ukraine. And if you look at that, the consequences on Europe were actually quite brutal, and we have heard summaries of that in the morning economic activity and productivity did slow down quite dramatically. The inflation shock was very pronounced, and in my line of business, public spending and the budgets were under pressure. So the type of consequences from the patterns that you were worrying about are actually quite pronounced. Stop it.
Clemens?
Yes, thanks. Maybe to start, how do companies react to changing interest rates? We just ran a survey among companies asking them how has the recent increase in interest rate affected your investment, and the result is, I guess, not so easy to read. So overall, companies, the average answer was companies have reduced investment by 8.4%. So if the increase, I don't know, if the increase in interest rates for them was kind of 3 or 4%, they reduced investment by 8.4%. Is that a lot or not? To I guess it's quite a lot. But then if you look at who answered, 80% of the companies said we didn't change anything. And this whole effect comes from 20% of the companies who said they cut their investment by on average 40%. So, I mean, it would be important to relate that to other surveys and see, how representative this evidence is. But it seems to be very heterogeneous across firms. And related to that, maybe about the impact of these structural shocks on R star. I think it's a really tricky question. If we take the trade frictions, for instance, you could say, as you mentioned, yes, companies will invest more into reshoring. So driving up our star, but you could also say maybe it's just different for different countries. Currently, a lot of German companies are saying we are not investing in Europe at all due to these frictions. We are just investing in the US. So that would mean it would drive down our star for Europe, I guess, and drive it up for the US. How about decarbonization? Maybe there are like two equilibria. One where, yes, we decarbonize in the whole world in that case and come to a world which is stable, but with a lot of investment, with high R star. Or maybe we don't invest, although the whole world doesn't invest enough. We get higher temperatures and a lot more volatility. That might also depress investment and lead countries to only react to these disasters, but maybe growth will go down and it will be a low growth environment. So I really think there is, it's even theoretically unclear where we end up. The last point, will deglobalization make inflation targeting easier? Yes and no. Yes, because you don't get these oil price shocks, but if you're in a closed economy, you also have fewer buffers to respond to shocks. If demand declines domestically, you can't sell your stuff abroad. So globalization is insurance. So maybe we will have face more volatility, and the central bank may find it easier to steer the economy, but it may also have to steer it more because we get more shocks.
Great. Okay, so then let's open the floor for further questions. I already saw 2 questions here and there. Oh, it's overwhelming. It's like, I see so many questions. I'm staring in the headlight now. So let's start with the 2 questions right there.
Good afternoon, Brunello Rosa Rubini. So we heard about the geopolitical tensions, frictions to trade and so on. These may require large public investment to counter some of these effects. In particular, could be in defense. Now, this may lead to larger public deficit and rising debt. The question for me would be, for the panel, but in particular I would expect for Isabel Schnabel, what the ECB will do in that case. Would that accommodate this rising in expenditure? Or would they counter the potential inflationary impact of that expenditure? Thank you.
Thank you. Lorenzo Codogno, LSE and LCMA. I have two questions for Isabel Schnabel. The first one, well, first of all, thank you for the fascinating and stimulating discussion on R-star. And the questions are, first of all, you mentioned correctly that, you know, ultimately it is about the balance and the dynamics between savings and investment. And I also said that it is, R-star is basically a global phenomenon, but limiting ourselves to the Eurozone, what can you say about the development since COVID? Because we have seen these savings from the public sector build up in savings from the private sector, and actually the start of an investment boom, which probably is still to come. So how can this be kind of translated into R-star? The second question is that you mentioned that R-star can or might be also used as a policy device because it can influence expectations and financial markets. My impression is that the Governing Council of the ECB has not yet started to discuss issues related to R-star and probably not yet started the pace of interest rate easing. But in the future, probably the timing of the cuts, the pace of the easing, and R-star are to be considered as part of the same kind of policy toolbox, if you want. How do you see the interplay between these three elements?
So there were three questions right there. So yeah, on that side, yes. And there.
Thank you. Great panel. Daniel Gross, Bocconi University. I have a comment question to both Clemens and Vítor. You both showed this chart with having a ratio of trade to GDP or to industrial production constant over the last years, while at the same time we had obvious trade tensions and fragmentation. But it could be that actually the type of fragmentation we have seen increases trade. So let me take the US-China trade war as an example. One implication of the trade war has been that fewer direct Chinese exports to the US, but more Chinese exports to Vietnam, then they're assembled and go to the United States. So that's a typical case where actually the supply chains become longer and you see more trade, but of course it's trade that is not welfare increasing. Therefore, the question is, shouldn't we no longer look at the ratio of trade to GDP as a welfare indicator? The second example of the consequence of this is that if I take the electrical vehicles market for electric cars, the American market is basically closed to Chinese exports. So that concentrates all the pressure on the European market, but the European producers have more leeway in the American market. So more trade between more exports from China to the EU and more exports from the EU to the US. Again, maybe the volume of trade increases and maybe the political tensions increase because in the EU now you have tendencies to restrict exports from China, when at the same time actually these same exports give us more opportunities in the US which are not taken into account. So these bilateral trade tensions can actually in the long run increase trade flows measured, but also political tensions and reduce welfare.
So, okay, so let's first right next to you. Yes, let's take, and then that one.
Thank you, Emmanuel Mensch. I have a question for Isabel. You showed this nice evidence on the secular decline of R-star in the US, or real interest rates, I should say, being centered around FOMC announcements. And you mentioned this research that shows that the dot plot publication by the FOMC seems to have an impact on private sector updates of real interest rate estimates. Do you really think, or what do you think is the informational advantage that central bankers might have over the private sector in thinking about the long-term sort of developments that drive real rates in the economy? Do you think there is an informational advantage, or what do you think is the story behind this result if it holds up in the data?
Thank Thanks. Final question, yes?
Thank you, Jumana Salihin, Vanguard. So my favorite topic, R-star. Pleased to hear central banks talking about it in real time, because that's not what happened after the global financial crisis and rates hit the zero lower bound. But I just wanted to connect the three panelists here and talk about, R-star. So globalization used to be a tailwind for advanced economies. You say it depends by region, but in general, all the estimates showed that it was. Is globalization going to work in the opposite direction and therefore mean higher interest rates? And also, Gaspar, you talked about the fiscal trilemma, and we know that in the Laubach and Williams paper, they talk about how structural deficits, which are estimated to be higher across many advanced economies going forward, are also going to affect R-star. So I guess my point is we might be moving to a world where monetary policy leaves the lower bound and becomes more normal, but actually you see fiscal policy picking up the burden. Thank you.
Okay, thanks very much. So since most of the questions are for Isabel, I'll give her a few more moments to think about the answers, and I suggest we go through the panel in the reverse order and to go through the questions. Clemens?
Okay. Now, could it be the case that frictions increase international trade? We have trade diversion. I also show that in the model. So trade with non-aligned countries in this block fragmentation scenario actually increased, and these countries also benefit. I'm not sure if overall trade would increase. I mean, maybe this can happen in the model, but I would say it's maybe more than an anomaly. I mean, you can imagine policies where policymakers are not very careful and you get these trade diversions. So rather than importing directly from China, the Mexicans to the US, the Mexicans buy the stuff in China, but the Americans take a very close look. For instance, in textiles, if you get the cotton from China, you have a problem as a producer, and you then deliver, textiles to the US. You really shouldn't even use the cotton because that can be detected. And so policymakers are aware of these diversion effects, and they don't like to be tricked. I mean, one thing that may create more trade, it's not exactly friction, but is CBAM. So CBAM puts a tax on importing certain materials. So what will happen then maybe is rather than importing steel from China to the EU, we will be importing cars built with dirty steel. So that could increase trade. Doesn't make it better. Thanks.
Thanks, Daniel. On your question, I can and I will look at the data. Possibility that you raised in terms of the data that we use and monitor. It's an interesting possibility. My gut feeling follows Clemens here, that I don't see that can overtake the trend. And on the welfare impacts, in my recent research, I've been trying to describe what happens in economic terms, including granular distribution effects, if I can, and be very shy about welfare effects, which I believe is something that requires deeper discussion among the economics profession. On the role of fiscal policy to determine or help determine long-run interest rates and equilibrium interest rates, sure, that is something which is completely confirmed both in theoretical frameworks and empirical evidence. And so that is actually a big deal. If you look at fiscal policies around the world at this point in time, most countries are coming closer to their pre-pandemic trends. And for most countries around the world, the forecasts are such that 2024 will see a transition to a more sustainable fiscal path and a gradual decline in the public debt to GDP ratios. The trend is not universal, and as always in fiscal policy, there is quite a large heterogeneity across countries. And I stop here.
Isabel, the remaining questions.
Yes, so I will try to be brief. On the first question, of course, you know very well we have a mandate that is price stability. We are not there to accommodate fiscal policy. So I think that's the short answer to that question. On the second question, it's also Lorenzo, and it's also a bit related to Humana. Is that how you say it? It also related, by the way, to what Clemens said. So first of all, I mean, you can for any factor you can find effects going in different directions. By the way, on the climate change, I really believe it goes mainly in one direction, because even if you don't invest now into the transition, I mean, then you will have to invest into adaptation, into repair and all of that. So I think it's almost unavoidable that there's going to be investment. But of course, on globalization and so on, I mean, there you can think about effects going in different directions. I mean, to Lorenzo, I think, so one point I wanted to make in the speech is that we really, when thinking about our star, I think we should take a global perspective. We should not, look at only that the euro area aggregates and then infer from that what is going to happen, because we know that this global our star is quite powerful, and we see these really strong co-movements across countries. So it could basically also be that, let's say, the euro area has low productivity going forward, but if the rest of the world is kind of moving ahead and doing a lot of investment in productivity growth, and artificial intelligence is giving productivity, is leading to productivity growth, then it could still be that our star even here goes up. So we should really take this global perspective. I think that's very important. I mean, on the discussion in the governing council, of course, I never tell you what we discuss in the governing council, but one thing that I think is that there is kind of the general perception that a star is not a very useful concept to operationalize, the meeting by meeting decision making, simply because what I mentioned, the confidence bands are so wide. But of course, one still can, even if we don't talk about specific numbers, I mean, people have, of course, views of what is going to happen with the long-run economy, and this is actually a discussion, and that is a point I wanted to make, that matters, and the communication about that discussion also matters a lot. So whether we are going out and saying, okay, so it's very likely that we're going to get back to this low growth world and the zero lower bound and so on, or whether we say, well, we're in a different regime, probably now, and it's likely that this is going to be persistent. That makes a big difference for what is going to happen. I mean, on Emmanuel's question, that's a difficult one. I mean, if you look at the Hilmrat paper, you see he goes at length going through different explanations. One of them is that, we have the central bank with a superior model. We actually just discussed it yesterday at the ECB. And, I must say, I also have a hard time to come to the conclusion that our star models are just so much better than everybody else's, and so I think, we have this empirical fact. It's a strong empirical fact, and we need to better understand. But I think we do not yet have the perfect explanation for what is happening. So you have a lot of work to do still in research. Thank you.
Okay, thanks very much for this fantastic session, and Volker will now conclude.
Thank you. I have three very brief remarks. First, we've just in this session heard a lot about R-star and R-star estimates. The Laubach-Williams estimates were mentioned a lot. That reminds me of the late Thomas Laubach, who died much too young at 55, and was director of multi-affairs. He's also been at those conferences. and speaking here as Director of Monetary Affairs, and not many of you may not know, but he was also a colleague and professor at the House of Finance here for many years before moving back to the Fed as Director of Monetary Affairs. He's being missed also here, and I know at least one of his good friends or family friends, Seth Carpenter, who's here, and maybe Seth will talk later, and you can also pass on to the family how he's being missed in the field here. The second point I want to mention is that if you found this useful, here is some information. I think to run this kind of event and conference, it's important to be independent. Not only the central banks need to be independent, we also need to be a bit independent of the central banks. So we actually fund the event independently of the ECB. There's a circle of friends of the ECB and its watchers who, and we rely on donations. And so if you want to join that group, we also meet occasionally in a hybrid fashion to discuss important things going on, not just with regard to the conference, but also with regard to the world economy. So just send me an email and I can get you involved. And finally, also very importantly, we have a small but very effective team, so I would ask you to join me in a round of applause for Jakob Liermann and Natascha Lenz and the IMFS team putting this together. And so good travels to wherever you're traveling today or tomorrow.